Thanks, Connor. So why are we talking about a new social order or a new social contract? There's a feeling, I think, that we're at a tipping point, peak problem, if you like. But what we've seen historically is that periods of instability, periods of rapid social change have led to significant changes in how we think about economies, how they are managed. As impact investors, we're looking for solutions to some of these global challenges, and often we're finding those in quite niche and surprising places. But we also need to think about our own impact, not just the companies. And the last part of this presentation will go into some detail on that. People are worried, and that worry is increasing. And I think some of the things that come out of this US survey, which is the annual trust barometer that they carry out there, is reflected in some of the outcomes from the recent election that you've had here. So people are worried about their jobs, people are worried about climate change, and they're worried about growing prejudice and racism. And that's a clear one, I think, in the US, given some of the events that we've seen more recently. But they're worried for good reason. There's a lot of evidence to support why those concerns are held. This is a statement from the latest IPCC report that there is unequivocal evidence that climate change is a threat to human well-being and planetary health. And that's the conclusion they reach with very high confidence. There isn't a lot of doubt about that. And similarly, there's a lot of data to support the rise of inequality and the stagnation of earnings growth. And also, I guess, some of the stuff that Bradley had on his charts are all of things that accumulate in the concerns that people have. Policy is often seen as a place to address these solutions. But I think what we recognize as investors is that businesses can help, and they should. This is again from that trust barometer. And businesses are seen by citizens as organizations that are able to take a lead in addressing some of these challenges. And the majority feel like they are best positioned to get results. But they're failing to do that. And again, the survey shows that most people think that businesses haven't responded well to the pandemic, and they haven't responded well to adapting to climate change. We can't afford to keep failing. And I think we've discussed a lot of the immediate concerns that people have in some of the previous slides. So the weather events are obviously very prominent here. COVID-19 not only highlighted risk to health systems, but also the unequal outcomes that arose from the response to the pandemic. So rising inequality. And to add to that, we've now got conflict in Europe, rising inflation, supply chain challenges. But a lot of these problems aren't new. They have their roots running for a very long time through the trends of globalization that, again, Bradley touched on, rising emissions really back to the Industrial Revolution, and growth in technology, which has changed the way that skills are rewarded and contributed to rising inequality. The good news is, though, that for a lot of these challenges, we have the technology to address them. The technology exists. So EVs, clean energy, renewable solutions, efficiency technologies. And again, COVID has highlighted what we really can do when pushed in the healthcare space. A vaccine was developed, multiple vaccines were developed in less than a year. That's unprecedented. And it wasn't just old medicine being used in different ways. This was mRNA medicine, which is a completely novel technology. So we can address these challenges, and the technology is there. And this is where we as impact investors find the solutions. The growth in the technologies that comes from addressing the challenges is where we see long-term investment opportunities. And some of these companies here address some of those, like renewables with Vestas, through wind, solar through SolarEdge, Fisher & Paykel, I'm sure you're all familiar with in the medical tech space, and medical research through ICON. But what about returns? Do you have to sacrifice making money to invest in these impact solutions? Theoretically, no. So the Porter hypothesis, and this is the same Porter who came up with the 5 forces, he has a theory about innovation and environmental regulation. So if a country has a lot of regulation, people are worried that companies will leave, go elsewhere, and you get a race to the bottom. What he thinks is that actually it encourages companies to innovate, it gives them a competitive advantage and puts the country in an overall better position. And this is data that comes from European Commission and from the US as well, and shows how many patents were registered in the overall sort of all technology, in low carbon technology and fossil fuels. And low carbon technology has been growing very strongly, whereas fossil fuels has been declining. So just conceptually, where is more likely to be an exciting investment opportunity? The place that investment is growing or the place where it's declining? And that's reflected also, that investment in technology is reflected in where you get more growth and where you get more employment opportunities. So again, this is data from Europe that shows the environmental economy clearly outpacing the overall economy when it comes to both growth and employment. So how do we translate that from the macro to the micro level? I've just got a couple of quick examples of how we look at that from the company level and from the bottom up. So Spirax-Sarco is a UK industrial engineering business that focuses on steam technology. And the picture on the right-hand side is their steam generator. And that has the potential to replace gas boilers across industrial processes. And at the moment, there is no such solution. No other company is providing that. So it's a huge opportunity for growth for this business. And it's not a pie-in-the-sky idea. This isn't a company that is pre-sales, pre-profit. For a long time, they've been generating strong margins, strong cash flow returns, and have been very strong performers up until recently in the index as well. Another example is Silicon Labs. Silicon Labs makes little chips that allow for connectivity in the Internet of Things. That has clear societal benefits, both in terms of more efficient homes, more efficient grid infrastructure, manufacturing processes, but it also has use cases in health in terms of monitoring of patients at home or elderly care. So the impact is clear, and the growth opportunity is even clearer if you look at that chart on the left. So that just shows the growth in the number of devices from 2021 to 2030, and it's clearly a significant opportunity when you compare it to growth in other types of devices. And again, Silicon Labs is an established business generating cash, generating profits, and we think has a clear opportunity to outperform on the basis of its unique technology and the growth that provides. So company impact is one thing, but I think the important thing about impact investing is that there is impact beyond what the companies do. We as investors have an impact, or should aim to have an impact as well. But we come on, so are we making a difference, I think, is the question. And the impact and ESG have both been criticised, and Adam touched on this earlier in terms of greenwashing, in terms of the risks of an asset bubble. But I think one of the things these things highlight, and this was talked about in the Financial Times article as well, is that what really comes out of this is that it's clear that the data from impact isn't being understood properly, and that means that risks aren't being priced properly. Impact data isn't just important for putting together a report that says we've saved 1 million tons of emissions. It's about market inefficiencies. Information and information costs and missing information is a known market failure and has an impact on market returns. Impact data is hard to find, so it falls under search costs because most companies don't report a lot of it. It isn't easily understood. It's very long-term. It's complex. All these challenges are interrelated, and they're not. The solutions aren't necessarily well established either. It's difficult to compare because the information isn't standardized, and all of that means that these externalities aren't being priced in. So particularly climate risk and the potential cost of carbon. And what does that mean for stock markets? So I think normally you'd expect me to show a nice chart that shows impact investing clearly outperforming all other forms. But the issue from the market inefficiency of information costs is the market isn't differentiating yet. It's not able to say this company is better than the other because we don't have that data and we don't have the ability to interpret it. So this Morgan Stanley study shows the difference in returns in sustainable funds versus general funds. And it doesn't show a big difference. And it was only till 2018, so you might see a bigger differentiation now. Notably, downside protection was better, so there is an element of defensiveness in this. But I think what this shows me is that there is still an opportunity to benefit from that mispricing and that absence of information. But to benefit from it, the information has to get better. People have to be able to price that risk. And for that, we need better measurement and reporting. There are already moves towards that. So there were 5 bodies that were looking at this, and they have come together and are trying to come up with one approach, which is already a start. But they're also looking to integrate that with gap reporting. So it's not seen as a separate thing. What you look at one thing over here, and then you've got the financials. They're combined and they're integrated so that you can value a stock in a sort of comprehensive way. Now, this slide might be the most boring slide ever because it is a timeline of US GAAP accounting. But the reason it's in there is to come back to that first point. Change happens when you see big shifts in global economies and in societies. Accounting started off in the US when 2 railroads published separate reports and people couldn't compare them. And that was really the genesis of where integrated reporting came from. And it was accelerated by big world events like the Depression and World War. And we had scandals. There was account swashing, if you like, with Enron, and it resulted in loss of capital for a lot of investors. And that's what we want to avoid, again, with this push to better measurement and reporting. IAS 22 is in there as a bit of a niche, but it's also there to highlight, so it's about goodwill accounting. People often criticize impact or ESG because it's non-financial information, it's subjective, we don't know what to do with it. We do account for brands, we account for the value of customer relationship, we account for the value of software over the next 20 years. So we're used to complexity and we're used to taking difficult concepts into account. And I think we just need to extend that beyond what we have traditionally done. And the other conclusion here is that these things take time. And I think we need to accelerate that process. I don't think we can afford to wait 100 years for those inefficiencies to be realized. And I think that's bringing it all together where impact investors have a role to play. And that means engaging with companies in terms of what they're reporting and encouraging them to create more comparable data. It means engaging with policymakers and standard setters. And it means engaging as an industry. I don't think impact reporting should be a competition between who has the most of a company's impact. That's not really the point. It's about discovering value in businesses and also about the market benefit of creating a more efficient market. And it creates a positive feedback loop. If you have more efficient markets, you have efficient capital allocation, that capital goes to the solutions that need it. It creates greater financial stability, and it addresses the problem of what happens when we start to see more market events from climate change, these risks coming through. Because as much as you can focus on individually sustainable companies, these are market risks. So everyone's returns are going to be affected if we don't address these problems. So there is a positive reason for everyone to think about this and to engage. And for us, going back to that initial point, it also creates opportunities for return. And this is really just to emphasize, this is a Global Impact Investing Network survey that asks people, why is this information important to you? And the majority said it's important for assessing business value. It's not just about doing good. It's not just about having a nice feeling about impact. It is relevant to business value and therefore is relevant to your opportunity for a return. These are just a couple of slides for conclusion to highlight how pertinent this issue is, particularly here in Australia, and you can see that in the global warming here versus the rest of the world. But we are seeing change. And again, the recent election highlighted the push towards that. And the little chart at the bottom is one that we have in our presentation that highlights this as almost the next industrial revolution or the technology revolution, where we see real opportunity. We don't see conscious capitalism as a watered-down version. It's trying to address market failures and market efficiencies for the benefit of markets, returns, and society. And that really, for us, is what impact investing is about. Thank you.